So Reuters polled the ECBs to hold the deposit rate at 2% on September.
This is the Daily Market Rundown live from the Tradelo trading floor. It's September the 4th. Some highlights from today's show. Markets are calm now before the storm. Japan elections are coming into focus, and the US APD data is now in focus. Good day traders, welcome, happy Thursday. A number of things going on, but I think the best place to start is just talk a little bit about what the market summary is coming into today's session. It's quite calm. I think that's the general sort of consensus. There's a relative calm. Bonds are moving sideways, equities are moving sideways, currencies are moving sideways. A little bit of an offer in some of the cryptocurrency space, but by and large, there is calm. Okay, now that makes absolute sense. We've got some key risk events that start later on today, and then of course we've got the main risk event of the week and perhaps of the month out tomorrow with the non-farm payrolls. Now we'll discuss non-farm payrolls in tomorrow's daily market rundown. We'll go through what to expect, some of the forecasts, but there are a number of expectations that have been put out there in some of the news this morning. I think the general line of thinking is a number below 40,000 on the headline print tomorrow is going to prove problematic. It'll also open the door to a potential 50 basis point cut at the September meeting, whereas numbers in excess of 150,000 will perhaps challenge ultimately this idea of a rate cut in September, but not necessarily remove it. I think that's the general line of thinking as we move into tomorrow. And then, like I've said earlier this week, the general feeling on the street is that every single person wants a pullback in the equity markets. No one wants to chase this rally. No one wants to pay the top tick. Everyone really just wants to get some sort of a pullback. And so what that typically means, if everyone wants to get long, we will perhaps get a correction, but it's probably going to be yet another shallow pullback. Now, some things to pay attention to. I think there's a lot of chatter and talk out there about the move we're seeing in the precious metals, predominantly led by gold and silver. And we've been talking a lot about this over the last couple of sessions. Goldman's come out with a bit of a forecast. It's an interesting one. It's a bit of a head scratcher. They're talking about $5,000 per fine ounce for gold, but they're looking at this as a bit of an extreme scenario whereby the Fed loses its sort of independence and credibility, and as a result, we see investors abroad begin the process of dumping US bonds. Okay, they're looking at if there was to be 1% of all US treasuries sold as a reasoning for a Fed losing its independence, gold should catapult all the way to $5,000. Now currently we can see gold prices around $3,500, so quite a significant move, almost another 40% move in prices to the upside. So again, I think the important thing to stress and to understand from this perspective is that the gold trend didn't start recently. It started at the start of 2024 when the Fed said we're not going to prioritize inflation. They have now opened the door to rate cuts in September despite the fact that inflation's ticking up, and we are obviously seeing constant attacks on Fed independence. So the way to play this is, so long as we are going to see this sort of demand for lower rates at a time when inflation is running hot, the reality is the gold trend remains to the upside. And then very, very importantly, should we see a staged event in the bonds? What's a staged event? It's a forced liquidation move. Should we see investors liquidating bonds? Okay, we've been talking about that US 30-year at 510 for some time now. We get above 510 and suddenly we're at 540, you will see the likes of the gold market up, another $300, $400, $500. Okay, that is kind of the play we're looking at, is if we are going to get a staged event in the bonds, you can bet your bottom dollar gold is going to be a lot higher than where it is currently today. Okay, with that in mind, I think the bonds are a little bit calmer today, and yesterday we have seen a reversal. We did have a pretty good Japanese bond auction. Now again, I say good, not great, because the bid to cover was in line with ultimately what seasonality suggests and the 12-month average suggests. But the key takeaways, don't forget, 30-year bond yields when issued were much higher. Okay, so investors were being enticed at higher yields, and ultimately that's why we had a good bid to cover. Okay, ultimately what we have to ask ourselves is, does this change the landscape for longer dated yield? Absolutely not. Okay, this is not going away anytime soon. We are only going to see more volatility in bonds as a result of, like I've been saying, okay, investors want higher yields. They're not going to accept higher inflation. They're expecting central banks to get their act together and squash inflation. Okay, so that's the point, is the likes of the UK, the likes of the US, the likes of Japan, until they get their fiscal priorities in order, we are going to see continued vol, particularly in the long end of the curve. Okay. Like I said, we'll talk a little bit about Japan, particularly as we move into next week, because we do have a very important leadership election coming on Monday, and ultimately there's a number of candidates there. Some are more sort of fiscally hawkish, and some are more fiscally dovish, and so it's very, very important we understand who ultimately wins that leadership battle, because if we did have a scenario in which we had someone that's a lavish spender come into power at a time when, of course, 30-year bond yields are volatile and moving to the upside, that could create a chaos and, like I said, a staged event as soon as Monday. Important to stress that Monday is an important day when you come in, particularly in Europe. It's an important day to be switched on with the bonds, because if there is a bit of a leadership challenge and we do see a scenario in which a big spender comes into the Japanese parliament, ultimately that is going to be problematic for bonds, not just in Japan but around the world. Okay. Now, in terms of course, one or two other things just to pay attention to, like I said, we do have an overnight report suggesting that there are sort of very high short positions now sitting in the bond space. Now, the way to understand this, it's to take it into context. The consensus play and where most of the weight of sort of outstanding positioning is in terms of the bond curve, it's to be ultimately short the back end, long the front end, or a steepener play. Okay, that's the play that's been on not just recently, but it's been on for now almost a year, which is playing for a steeper curve, and that's not going to change anytime soon. But what it does mean is that the positioning, perhaps from 10 years out in terms of the curve, is still quite short. Okay, now why does that matter? Well, if you looked at the 10-year bonds, they've been slowly drifting higher the last couple of sessions, and so should we get that very weak non-farm payrolls number tomorrow, I wouldn't be surprised to see some of those short positions get stressed and perhaps do see a little bit of a liquidation move in terms of some of those shorts, and perhaps see quite a big dramatic move in the 10-year bond space. Okay, so keep an eye on that. I think it's definitely one to pay attention to. Positioning is not something we think about every day. It's just something we want to be aware of, because when those crazy ass moves come in, we want to make sure that we're not on the wrong side of them, and we actually understand why they happened before they happen. Okay, now turning to some of the interesting charts, what we've got for you here is out of Japan, a little bit of chart porn coming from the Discord channel, and what we're trying to do is plot ultimately in the white line the implications of Japanese yields on global markets. Okay, that's the way to think about it. Does Japanese yields have a problem for global markets? And I think it comes back to yesterday's rundown where we said it does and it doesn't. Okay, and it's all about rate of change. It's all about, if 30-year bond yields move 30 basis points in a space of 30 minutes, that's very different to moving 30 basis points over 3, 4, 5 months. Okay, two different scenarios. So rate of change matters a lot. But what we can see is when we get that significant rate of change like we had at the start of last year, we can see that increases the VIX in orange. Okay, so it picks vol up across the board. Now this might not look like a lot, but it's a move well above 20 to 25 in the VIX. Okay, and as a result of that, ultimately we can see those equities under pressure. Okay, so it's just looking at ultimately some of these moves. Again, we saw something like that in May where we had a nice little spike to new highs in terms of 30-year. It was quite a volatile move, and of course we can see that there was a little bit of an uptick in that vol, and of course equities staged an offer. Okay, and that's what we're trying to look at. We're just trying to see ultimately what are the implications. Do 30-year yields matter? And the short answer is they do and they don't. Okay, they do matter. The trend is obviously firmly to the upside, but it's very much about that stage move. Should we see 30-year yields, spike 25, 30 basis points in a session, you can bet your bottom dollar these equities are likely to offer. Now, context matters a lot here, because sometimes when we look at correlations, we go, oh no, this correlation doesn't work, it's rubbish. Sometimes it works, sometimes it doesn't. Context of the market matters. Remember what I said at the start of this. everyone on the street is looking for a correction in equities. So if everyone's looking for a correction in equities, and ultimately we suddenly got a spike in yields, in that context, the probability of a sell-off in equities because of that spike in Japanese yields makes a lot more sense. Okay, context always matters, and importantly, when you do look at correlations and you overlay charts, make sure you interpret that context, because it does matter a great deal. Okay, now turning our attention to gold. Goldman Sachs says it's going to 5,000, and I think it's definitely something to pay attention to. What we can see, of course, that 200 moving average is sitting at 3,000, so we are sitting at a significant premium to trend. But this is not new. This has been the case since the start of 2024. We've now had quite a dramatic move since the Lisa Cook flare up, and of course the Jackson Hole. We've moved well into record territory. What I want to stress here again, a continuation theme. We are in a process of one-time framing that's not going to end anytime soon. We're still relatively early sequence. These can go on for 10 to 15 days before we see a close below previous day. What I want to stress is, looking at today, notice how quickly that dip got bought up. Okay, it really tells you that there are buyers sitting desperately hoping for some form of pullback to initiate. I do think 3,500 ultimately is going to act as a very important area for gold, but like I said, everyone of influence started buying it already around 3,400. They're well on side now, and so they're just going to be adding to positions as this moves higher and higher. Don't forget, of course, also the CTAs are chasing this. It's just got everything going from it from a technical perspective. Okay, keep an eye on gold. It is one to dip buy only. Do not stand on the other side and provide liquidity, because we are in price discovery mode. With regards to silver, it's another one that looks just as interesting, just as sexy, just as strong in terms of one-time framing. Started a little bit, it started at the same time as gold, but perhaps not as directional. It is having slightly better pullbacks. So again, if you are a silver trader, don't be afraid to trade silver off of gold. So long as gold is strong, of course, silver is going to piggyback off of that. Okay. And I think just in terms of that market recap, very interesting. What I wanted to point out here is this idea of relative calm. Okay, is there relative calm? Well, yes, arguably there is, but we can see that there is sort of a bit of nervousness in a sense. And Nvidia is down 2% in the week, but Apple's up 2%. Microsoft flat, Tesla flat, Meta flat, and it's Thursday. Okay. Yes, we had a holiday this week, but the fact is markets are waiting for non-farm payrolls. And what that means is, as we approach the markets today, as we approach the equities, if you're trading the equities, you can expect another flat line session where the market looks like it's doing something, but actually it does absolutely nothing. Okay. If anything, don't be surprised to see a little bit of vol, given we are going to obviously have ADP out. And I think that's one to talk about. And I think Michael Brown put out a really cool post today, and it's a good one to read on Twitter. What he was doing was ultimately, there's been this long-standing debate that ADP is a horrible predictor of NFP. It used to be good. It hasn't been good for 6 or 7 years, which is why I never talk about it. But ultimately what he did was he mapped out ADP against the revised NFP print. So what he did was a correlation between ADP and the revised NFP print. And what it seems to do is ADP does act as a slightly better precursor to NFP, but ultimately the revised one, not the actual one that comes out tomorrow. So what does this mean? Perhaps a great deal of nothing, but I do think ADP is going to take a little bit more of an important role today, just given how sensitive the markets are to the print tomorrow. Okay, so what I mean by that, a bad number in the ADP today, the markets will kind of perk up. They will be a little bit concerned. You'll see a little bit of vol come back into the space. You'll see equities offer a little bit, and gold perhaps make its way back up to yesterday's highs. But a good number, a slight beat, well, the markets are going to yawn. They're going to say, that's got nothing to do with non-farm payrolls. Okay, that's how you have to look at this. A bad number today will matter. A good number today is going to mostly be yawned away. What is a bad number? Well, we know we've printed a sub or negative a couple of months ago. So a negative number will matter. I think it will be very interesting. The markets will kind of be a bit of a head scratcher. I think 68 is expected with a range of 35 to 110. I think anything less than 30k, that's going to get the market's interest. Negative number, like I said, it's pretty much going to be a risk-off session as the market gets to work, perhaps doing a little bit more hedging as we move into that non-farm payrolls event tomorrow. Okay, with that in mind, keep your powder dry. I think that's the key takeaway today. Not a day to go guns blazing. You don't need to make your month today. That's perhaps something we can leave for tomorrow. If there are any other questions, do post them in the Discord channel. Otherwise, good luck out there. Go manage that risk. Go make some money.